Let's just start there. Isn't this the golden era for pensions where they can actually get the returns that they need to get to meet their obligations?
Well, clearly, fixed income returns are much better than they were a year or two or three ago. But money pension funds in the United States, state pension funds, are underfunded still. And even CalPERS, which is the largest state pension fund at $465 billion, is underfunded. Underfunded in the sense that actuarially it's about 20% below having full funding. Now, these pension funds are still in better shape than the U.S. government's Social Security program, which is not funded at all. That's a completely pay-as-you-go program, and that's much worse shape, relatively speaking, compared to the state pension funds. But some state pension funds are massively underfunded. Kentucky, Connecticut, Illinois are funded at maybe 40% of their overall obligation. So it's a challenge, and the fixed income rates that are now higher than they were before are a plus for those funds for sure, but there are many state pension funds that are still massively underfunded.
And this is a reason why there had been a concern in a low-rate environment of how much some of these funds would have to lever up to get the returns that they needed to become funded. At this point, do you feel like the risk-taking appetite, I should say, among some of these funds is diminished or has grown as they see the opportunity to actually meet those obligations without asking for additional contributions from members?
Well, I think a lot of the state pension funds are pleased that the fixed income element of their portfolio is now going to perform much better. So if you can get 5% yields on treasuries, you're getting very close to what you need to do, which is a 6.8% in CalPERS case. But most of the state pension funds are designed for actuarial purposes to yield about 6 to 7% or so a year. Some of them are able to do it and some are not. But I would say the easy money is probably behind them, which is to say the high-tech world, which showed some really great equity returns in recent years, that's probably behind most of the state pension funds now. They're really going to have to do the hard work of getting this without the high rates of return that you often got in venture capital or other kinds of private investments.
Money never feels easy, David. Come on. At what point has it ever been easy money at a certain time when people are looking forward? How much are they looking to private equity to sort of give that same kind of feeling going forward?
Well, private equity has performed pretty well over the last 10, 20, and 30 years or so for large public pension funds. And those that have done very well are the ones that have done enormous amounts of private equity. For example, the best funded state pension fund in the United States is probably the state of Washington. The state of Washington is overfunded by more than 100%. It has about 120% or so what it needs. And they have used a lot of private equity to get there. So those that were participating in private equity from the 1980s, 90s and on have actually done pretty well. Some have lagged behind. I think the biggest issue you have now is that you have expectations are very high among employees about what their retirement benefits are going to be, and we have to make certain that we can actually achieve those retirement benefits. It's very easy for state legislatures to say we're going to give you certain benefits, but it's actually not as easy to earn those benefits, and therefore you either have to increase the taxation on everybody in the state, or you have to which means the state contribution to the pension funds is greater, or you have to increase the tax in effect that the pensioneers or future pensioneers are paying, and that's the only way you deal with it. You can sometimes get a higher rate of return, but there's no easy way. You either pay people, you either tax people higher, or you have to have higher rates of return. It's no easy way to get to the desired results. Now, as I mentioned earlier, Social Security system we have in this country is a pay-as-you-go system. So when I pay my Social Security out of my salary every week or so, that's going to fund benefits right away. We don't have a system like Canada or Australia or most countries where you have a funded national pension system. We're never going to be able to afford that, unfortunately, because we have promised benefits that are so high that we're just not going to be able to achieve the kind of system we have in Canada, where they fully funded, or not almost fully funded, the pension benefits that they promised their workers.
Not to diverge too much from the point, but isn't this part of the reason why yields have risen as much as they have on treasuries, particularly on the long end, as people take a look at that fiscal situation and don't really see an answer for how it's going to come more into balance?
Well, yields have gone up because interest rates have gone up, and that's made it easier for people who are fixed income investors to get a higher rate of return, and that will probably continue for some time. But I do think that it's an issue that all of us have to deal with because we have a demographic issue in the United States. People are living longer than they were before. For example, when the Social Security system was set up in roughly 1934 or so, the average American lived to about 65 years old. And so you were able to collect your Social Security at 65. So there wasn't a big gap because most people weren't living too much longer than they were going to be eligible to get their pension benefit from Social Security. Now, if the average age is, let's say, 81, 82, 83, you've got a big gap there because people are retiring, let's say, and collecting their Social Security at 65 or 67 or 70, but they're living much longer. And in addition, we've taken the Social Security system and used it for so many other purposes. So we have a big gap. And in the end, the only way to solve that problem is increasing taxes on Social Security, which is hard to do politically, or you have to reduce benefits, which is even harder to do. So there's no easy way out of that problem. And
it's something that we're going to hear about politicians speaking gingerly about, certainly in an election season. Going back to this question around how some of the pension plans that do have to be funded are handling this, do you expect them to lean more into alternatives at a time where some people are questioning whether the golden era is over? Whether we've already seen, particularly with the IPO market in stasis in the sense of takeouts not really happening to the same degree, that it's going to be more humdrum rather than the explosive returns and growth that we've seen over the past few decades?
Well, the market is more saturated than it was 20 or 30 years ago, there's no doubt. And returns will be harder to achieve. But there's no doubt that alternative investments, which may mean, I'd say, distressed real estate, distressed debt, buyouts, growth capital, venture capital, those things tend to outperform public equities by a fair bit. And as long as people need to get higher yields, you're going to see a fair amount of money going into these so-called alternatives. Will they outperform by the same amount that they did 10 or 20 years ago? Maybe not, but it will outperform. There's no doubt about it, in my view.
David, there's also a question around this.
The person I...
Go ahead.
Go ahead.
Well, I was just going to shift real quickly.
I'm saying the person I interviewed
to talk about whether there's going to be also a continued focus on ESG, et cetera, given the fact that there has been quite a bit of pushback. And I know that you did speak with Nicole Musicco about that. What did she have to say about that?
Right. Well, ESG has become controversial in the United States. The controversy over ESG does not really exist so much outside the United States. Obviously, we politicize it in the United States to some extent, but I don't think ESG is going away. I think people will talk about it less. Larry Fink, for example, says he doesn't use the word ESG anymore, the phrase ESG, because it's so incendiary in the minds of some. But the truth is that most investors want to have some sense that the investments they're doing are not destroying the environment or doing things that are, I'd say, not appropriate. But there's no doubt that some people have fought back, and there is a reaction against ESG in the United States. I don't think it's going to mean that ESG is going away, but people are talking about it more gingerly, let's say.